Welcome to session 2.6b, where there's several examples of how to do an indirect cash flow statement. You'll find these videos in Module 3. So what are we doing today? We're going to look at a few more examples of how to do a cash flow statement, the indirect method or the indirect approach. You remember that the steps of doing a cash flow statement are, number one, find the answer, which is the change in cash between the beginning and ending cash. Then go cruise through your income statement and look for what net income is, and then what non-cash expenses are, like depreciation and amortization, and what the gains and losses on, say, property, plant, and equipment are. Also, and that will give you the first part. Second part of finding cash flow from operations is to compute the changes in the current assets and current liabilities, and those also go in cash flow from operations. The second part is to look at the investing section, which all can be found in the non-current asset account changes, and you need to analyze by T account any non-current asset account, like property, plant, equipment, accumulated depreciation. That will give you investing. Then look at financing section, and that's analyzing the T accounts in long-term liabilities accounts, contributed capital, and retained earnings. And all of that goes into financing. And then you net the cash from operating, investing, and financing, and that will give you the change in cash again. So let's try a few. Here's a problem. We're given the balance sheet and the income statement. From the income statement, we can see what net income is. We can find the depreciation expense, and we also see there was a loss from the sale of investments. So those are the three items that we will use in the cash flow from operations. The second part of it is to look at the changes in our current assets and our current liabilities. There. So what are they? Well, first off, what's the change in cash? The change in cash, what we're searching for is $2,600. Cash goes down. Accounts receivable also decreased. It appears 6,000. Inventory decreased 1,000. Interest receivable decreased 2,200. Prepaid rent increased 2,700. And we know that these have an inverse relationship with cash. So if these accounts go down, cash goes up. If the account goes up, cash went down. Looking at our accounts payable went up 3,900. If I can do my math, there, 3,900. Wages payable went down 400. Interest payable went down 300. Dividends payable went down 800. Taxes payable went down 2,000. Unearned revenue went down $2,400. And we know that in current liabilities, there's the same relationship. So if accounts payable or any current liability goes down, cash went down. If the current liability goes up, cash goes up. So that's our first part, and from all of this information, we can find the cash from operations. And that's all this problem wants us to do, is to prepare the operating section of the cash flow statement. So let's do that. All right, we took our net income, we added back the depreciation and the loss, we took care of our current assets, we took care of our current liabilities, and we find that the cash from operations is $29,500. So we may have had a net income of $2,800, but our cash from operations was $29,500. So one of those ratios we did was cash from ops divided by net income. So in this case, it's very favorable because $29,500 divided by $2,800 exceeds 10. So as far as is this company able to generate cash, even though its net income is low? It is, and that's a good sign. Here's a second one. This one's a little bit harder because there's some accounts in here that you haven't seen before, but I think you can do it. So once again, we have our income statement, and our income statement has net income of $2,000. We have depreciation expense, and I don't see any gains or losses from the sale of non-current assets. So we have those two items. We look for our change in cash, and we see that the answer, the bottom line we're going for, is that cash increased $4,000. Our accounts receivable increased $5,000. The allowance for doubtful account is a contra accounts receivable account, and notice it went up $1,000, or excuse me, $500, so it increased. Inventory went down $2,000, and then that's it for our current assets. Our current liabilities, there's just two. Accounts payable decreased $1,000, and deferred revenues decreased $1,000. We then would go and analyze our long-term assets, on our non-current liabilities, our common stock, and retained earnings. So let's take a look at that. But we have enough here to do cash flow from operations. So analyzing our long-lived assets. It started the year at 1,000. It ended the year at 12,000. So since there's no additional information, the only thing I can conclude is that I bought $1,000 worth of long-lived assets. If I look at accumulated depreciation, it started the year at 2,000. I know my depreciation expense was 2,000, and so that gives me my ending balance of 4,000. So confirmation that I did not buy any long-lived assets or I did not dispose of any long-lived assets. When I look at my long-term note payable, it didn't change, but that discount on note payable went down $2,000. And we'll spend a whole chapter on discounts, but know that that discount is a contra liability account. And in this case, since it's related to a long-term note payable, it also is treated as long-term. Common stock went up $6,000, so I must have sold some stock. And then when I analyzed my retained earnings, beginning of the year was $3,500, end of the year was $48,000. I know from the income statement, net income was $2,000, so I must have paid dividends of of 700. So we've analyzed everything. We have all the pieces. Now let's just put it together. So when I put it together, I start with my net income. I add back my depreciation, and those came from the income statement. My current assets, we know that there's an inverse relationship, so if accounts receivable goes up, we subtract. If inventory goes down, we add. But the allowance for doubtful accounts or bad debts is a contra account, so it acts contrary to that. So if the allowance goes one way, then it will go the other way. Current liabilities, if they go down, the impact on cash is the same. So we find our cash from operations is 500. We bought that long-lived asset of 1,000, so that's our investing. Financing, the discount on note payable, because it's a contra long-term liability, it acts contrary. In other words, it acts like an asset. So if the discount goes down, then we add it back. We issued stock. We paid dividends. So our cash from financing is 5,500. And netting all of these, we find our change in cash of 4,000, which was the change in the cash account. Add that to the beginning cash, and you end up with the ending cash of 10,000. One more. Here we have Sharma Fabrics, and we're given an income statement and then a whole bunch of dense information where I can see we have gains, we've got equipment purchases, we have a patent amortization, which is just like depreciation, we have a purchase of an intangible patent, we have funds borrowed, we have notes paid, we have land and building purchased, we have a mortgage, and we sold some stock, and we paid a dividend. So there's lots of things going on. Oh, and they tell me my depreciation, and they tell me my net income. So that's all that additional stuff. All right, step one, find the answer. What was the change in the cash accounts? $34,400. It increased. Change in accounts receivable. Accounts receivable went up 54,000, so we'll subtract it. So the impact on cash is a subtract. Inventory went down. The only time inventory goes down is if I make a sale, so cash would go up. My prepaid expenses went down, so my cash goes up. I'll analyze all of these in a second. Current liabilities, accounts payable went down 52,000, so that's a reduction in cash. Notes payable went up 20, so cash goes up 20. Accrued liabilities goes down, so cash will go down. We'll analyze the rest of these in a second. All right, so remember all that additional information, and we're going to turn the page and see what else we can do. All right, from the additional information, we learned about net income, depreciation expense, gain, and amortization. And we also know about the changes in current assets and our changes in current liabilities to come up with our cash from operations. We then have to analyze our property, plant, and equipment. So we know that equipment on the balance sheet started the year at 68, ended the year at 66. In Part G, it tells me that I bought equipment, or in Part D, I bought equipment for $25,000. And it also tells me I sold equipment that cost $27,000, but that's not the amount of cash that I received. So I need to reconstruct the sale entry to figure out how much cash was involved. All right, so I know about equipment and I can reconcile that, and I'm still waiting to see how much cash I sold that equipment for. Accumulated depreciation started the year at 48 according to the balance sheet, ended the year at 29,000. We know that our debt entry was 6, and that's already in here. Oh, for equipment. And the depreciation on the equipment that we sold was 25. So we know we also had a gain on that sale of equipment at 10,600. So the amount of cash that I received when I sold that equipment was 12,600. And that's what shows up in the investing section, the amount of cash you receive, not all the other stuff that's in there. All right, so that's the equipment. We also had property, plant, and equipment, where it says we bought land in a building, and in Part G it tells me the amount of the land and the building that we purchased, and it also tells me that I got a mortgage on that, which is a financing. So those reconcile the land and the building accounts. They went from 0 to these amounts. The other thing that we have to analyze is the patent. And the patent started the year, it's an intangible asset, and we haven't looked at it before, at 12,000, ended the year with 8,000. And it also told me that I bought a patent for 2,000, and so that's why we show buy a patent. But that doesn't balance. But I also know that on the income statement that I amortized a patent for 6. And so now I'm able to tie out the patent account for the purchase of a patent and for the amortization expense that I took on it. Notice that patent doesn't have an accumulated amortization account. You just reduce this intangible by the amount that it's being amortized by. All right, so that gives us operating, it gives us investing changes. Financing, well, it told me in Part G the mortgage was $324,000, so that's a source of cash. We analyze our common stock account, and we can see that the change in that common stock account was when we issued the stock for $100,000, and we know that because $60,000 of it was common stock, and $40,000 was that the investors paid more than what's printed on the common stock certificate. So they paid in capital or paid in resources in excess of what we call the par value of the common stock. So they paid $100,000 for $60,000 that's printed on the stock. So paid in capital goes in the rest, but I got $100,000 cash when I issued the stock. Finally, I reconcile retained earnings, started the year, ended the year, know the net income from the additional information. Also, it tells me that my dividends were $18,000, so that's a cash outflow. So operating, investing, and financing gives me that change in cash that I was looking for, because that's the change in the cash account. Add to it beginning cash, and that will give me ending cash. So this is a little bit more involved problem, but as you can see, if you know where you're headed, that change in cash, you're usually able to figure it out pretty well.